On March 9, 2023, customers pulled $42 billion out of Silicon Valley Bank in a single day. Another $100 billion was lined up to leave the next morning. The bank did not have weeks to respond. It barely had hours. And that exposes one of the strangest facts about banking. A bank can own billions of dollars in valuable assets and still fail because too many people ask for cash at the same time. That is the paradox at the heart of a bank run. And the most dangerous part is that panic does not always begin because a bank is already insolvent. Sometimes panic helps create the collapse itself. To understand how that is possible, you first have to understand what a bank actually does with your money. When you deposit money into a bank, those dollars do not sit untouched in a vault with your name attached to them. Modern banks take deposits and put much of that money to work. They issue mortgages, they finance businesses, they purchase government securities. They hold other assets that may not mature for years.
This is one of banking's central economic functions. Short-term money from depositors helps finance longer-term activity across the economy. But it also creates a structural mismatch. Your deposit is a short-term promise. You may ask for it back today. The mortgage funded by that deposit might last 30 years. A long-term loan or security may have substantial value, but converting it into cash immediately can require borrowing against it or selling it quickly, sometimes at an unfavorable price. Economists call this liquidity transformation. Under normal conditions, it works remarkably well. Most customers do not withdraw all of their money at exactly the same time. So a bank does not need enough cash sitting idle to repay every depositor simultaneously. It needs enough liquidity to satisfy ordinary withdrawals, while the rest of its balance sheet supports lending and investment. The system therefore rests on one quiet assumption. Most depositors will not demand their money at once. A bank run begins when that assumption breaks.
And this is where two very different problems are often confused. A bank can be insolvent. That means the value of its assets is genuinely insufficient to cover what it owes. That is a balance sheet problem. But a bank can also face a liquidity crisis. Its assets may still have substantial value, yet the bank cannot turn enough of those assets into cash quickly enough to satisfy a sudden flood of withdrawals. That distinction matters. Imagine a bank owns long-term securities worth billions of dollars. If it can hold them, collect payments, or wait until maturity, those assets may continue to provide value. But if the bank suddenly needs enormous amounts of cash today, it may be forced to sell assets immediately. And if market prices are unfavorable, those sales can crystallize losses that had previously existed only on paper. A liquidity problem can begin exposing a solvency problem, or it can help create one. From the outside, those situations may look almost identical in the first hours of a panic. That uncertainty is one reason bank runs can accelerate so quickly.
Long before mobile banking, the panic was visible. In the 19th and early 20th centuries, many ordinary depositors who feared for their savings had to physically go to a bank branch. A rumor could become a line, and the line itself could become evidence. People walking past a bank might see dozens of anxious depositors waiting outside. They might know nothing about the institution's balance sheet, but they understood the crowd. If enough people appeared worried about getting their money back, everyone else suddenly had a reason to worry too. News traveled by conversation, newspapers, telegraph, and eventually radio. Fear spread from one depositor to another, and sometimes from one bank to the next. During the Great Depression, that dynamic became devastating. Economic contraction weakened banks. Bank failures frightened depositors. Frightened depositors withdrew money from other banks. Those withdrawals weakened institutions that might otherwise have survived. Failure created fear. Fear created withdrawals. Withdrawals created more failures. The cycle fed itself. Thousands of American banks eventually failed during the Depression era, and the experience fundamentally changed how governments thought about financial stability.
Decades later, Northern Rock demonstrated how the speed of panic was beginning to change. In September 2007, the British bank required emergency liquidity support from the Bank of England. Television cameras soon showed queues outside branches. The images traveled across the country far faster than the old local rumors of earlier banking panics. The crowd was still physical, but the panic had become national. Millions of people could now see evidence of a bank run without being anywhere near the bank itself. Then came Silicon Valley Bank, and the queue almost disappeared. SVB's problem did not begin on the morning depositors started running. Its vulnerabilities had been developing for years. During the technology boom, the bank received enormous inflows of deposits from startups, venture-backed companies, and firms connected to the technology industry. The bank grew rapidly. A large portion of those deposits was invested in medium and long-term Treasury and agency securities. These were not reckless speculative assets in the traditional sense. Their credit risk was considered low. But long-duration fixed-rate securities have another vulnerability: interest rates.
When interest rates rise, the market value of older fixed-rate securities generally falls, and rates did rise sharply. That left SVB with substantial unrealized losses on its securities portfolio. As long as the bank did not need to sell those securities in large quantities, much of that damage could remain unrealized. But SVB had another vulnerability. Its depositors were unusually concentrated. Many were technology companies. Many knew the same venture capital firms. And an unusually large share of their deposits was above the amount protected by ordinary deposit insurance. That changes the incentives dramatically. An insured depositor has a strong reason not to panic. Within the insured limit, the government safety net is designed to protect the deposit, even if the bank fails. An uninsured depositor faces a different calculation. If there is even a meaningful possibility of losing access to millions of dollars, waiting can become extremely expensive.
Then, in March 2023, SVB announced that it had sold securities at a significant loss and was attempting to raise new capital. The announcement was intended to strengthen the bank. Instead, it intensified concern about the bank's balance sheet. And SVB's depositors were not isolated individuals waiting to read tomorrow morning's newspaper. They were connected through venture capital networks, messaging groups, email, and social media. Warnings moved almost instantly. Companies were urged to withdraw. And these were not people standing outside branches asking tellers for bundles of cash. Corporate treasury teams could move enormous sums electronically. $42 billion left in a matter of hours. Another $100 billion was positioned to leave the following day. A 19th century bank simply could not have experienced a run at that physical speed. SVB was not destroyed by panic alone. The bank had genuine vulnerabilities before the run began. It had significant interest rate exposure. It had large unrealized losses. It had a highly concentrated depositor base. And most of those deposits were uninsured. The run did not invent those weaknesses. It exposed them. Then it accelerated them beyond the bank's ability to respond.
And underneath all of this is a psychological problem that has existed for centuries. Suppose you believe everyone else will leave their deposits in the bank. You may have no reason to withdraw yours. But now suppose you believe everyone else is about to leave. Suddenly, withdrawing first can become rational. Not because you have discovered that the bank is worthless, but because you are afraid that everyone else will reach the exit before you do. This creates a coordination problem. Each person may be making a perfectly reasonable decision from their own perspective. But when thousands of reasonable decisions happen at the same time, the collective result can become destructive.
A bank run does not require every depositor to believe a bank will fail. It only requires enough depositors to believe that enough other depositors are about to run. The psychology has changed surprisingly little. The speed has changed enormously. A 19th century run moved at the speed of a crowd gathering outside a building. A Depression-era panic moved through newspapers, radio, and word of mouth. Northern Rock unfolded under national television cameras. Silicon Valley Bank moved through smartphones, social networks, and digital transfers. The distance between fear and action has collapsed. Once, a worried depositor had to hear a rumor, travel to the bank, join the queue, reach the teller, and request the money. Today, suspicion can arrive as a message on a phone. Seconds later, the transfer can already be moving. That is one reason governments spent much of the 20th century building defenses against bank runs. Deposit insurance was designed to remove one of the most powerful reasons ordinary depositors have to panic. If people know their deposits are protected up to a defined limit, they have less incentive to race one another to the exit. Central banks can also provide emergency liquidity to institutions facing temporary funding pressure. The idea is simple. A bank with valuable assets should not necessarily have to collapse merely because it cannot transform those assets into cash fast enough during a temporary panic.
But these protections create their own debates. If depositors believe they will always be protected, they may pay less attention to the risks banks take. If banks expect emergency support, critics worry that management may take greater risks. Economists and regulators describe part of this problem as moral hazard. There is no perfect system. A financial system has to balance two dangers. Too little protection can allow panic to destroy institutions unnecessarily. Too much protection can weaken the incentives that normally restrain risk. So, can a bank run destroy a genuinely healthy bank? The answer is more complicated than yes or no. A bank with a strong balance sheet, diversified deposits, substantial liquidity, and reliable access to emergency funding is far better equipped to survive a withdrawal shock. But banking is built around transforming short-term funding into longer-term assets. That means liquidity always matters. A sufficiently large and sufficiently fast wave of withdrawals can put enormous pressure on almost any institution. Still, history shows something equally important. Runs rarely discover weakness from nowhere. They usually find vulnerabilities that already existed. An interest rate risk, an asset-liability mismatch, a concentrated depositor base, too little liquidity, too many uninsured deposits. A decision made years earlier that suddenly becomes important in a single afternoon. The run turns hidden weakness into visible crisis.
And that brings us back to the paradox. A bank does not need every depositor to believe in it forever. It needs most depositors to believe that they could get their money whenever they wanted. Because as long as everyone believes the door is open, almost nobody feels the need to rush through it. That shared confidence allows banks to turn short-term deposits into mortgages, business loans, and long-term investment. It allows the system to function quietly for years, until too many people decide to test the promise at exactly the same time. A bank run begins with money leaving an account, but what it is really measuring is trust. And in modern banking, trust can take decades to build and only hours to disappear.